Welcome back to the Deep Dive. Today, we're going to be tackling a classic in the world of finance.
Oh, yeah.
Benjamin Graham's The Intelligent Investor.
Mm-hmm.
I think most people listening have probably heard of this.
Right.
Considered by many to be like the Bible of value investing.
For good reason.
Yeah.
And what I think is fascinating about this book is that it's not just about picking stocks.
Right.
It's about building a mindset, like a framework for making sound investment decisions that withstand the test of time.
Yeah, and that's what I find so compelling about Graham's approach.
Yeah.
It's not about chasing quick riches or trying to time the market.
Right.
It's about creating a sustainable strategy for building wealth over the long haul.
And he does this by laying out a very clear distinction between investment and speculation right from the start.
Right.
In Chapter 1, he defines investment as an operation that promises safety of principal and a satisfactory return.
Okay.
Anything else is speculation.
So like day trading on Reddit trying to ride the latest meme stock wave. That's definitely not what Graham would consider intelligent investing.
Yeah, not quite.
Yeah.
He saw speculation as a risky game driven by emotion and often fueled by a lack of understanding of the underlying value of the assets involved.
You know, he saw this play out firsthand during the market crash of 1929,
Oh, absolutely.
a time when speculative frenzy led to devastating losses for many.
Yeah, that experience really shaped his approach to investing.
Yeah.
He wanted to provide investors with a more grounded and rational approach.
Yeah.
One that prioritized safety and long-term value over short-term gains.
So how does he suggest we navigate this line between investment and speculation?
Right.
It seems like a very fine line sometimes, especially in today's market.
Well, Graham breaks down 3 common approaches to speculation,
Oh.
each with its own set of pitfalls.
Okay.
First, there's market timing, trying to predict the market's peaks and valleys to buy low and sell high.
Ah, yes, the elusive quest to time the market perfectly.
Right.
I've tried that. It's more like trying to catch lightning in a bottle.
It is. And even seasoned professionals struggle to consistently time the market.
Oh, for sure.
Then there's a short-term selectivity,
Okay.
focusing on stocks expected to jump in the near future, maybe due to an earnings report or a product launch.
Right. Chasing those quick wins.
Yeah.
But it seems like a recipe for stress and potential disappointment.
It can be. And those short-term gains are often fleeting, and the risk is that you might miss out on the long-term growth potential of a solid company by constantly jumping in and out of positions.
Yeah. And then there's long-term selectivity, which on the surface seems more aligned with Graham's philosophy,
Right.
focusing on companies with strong growth prospects.
Yes, but Graham cautions against blindly chasing growth.
Okay.
Even companies with a great track record can become overvalued.
Right.
And when that growth slows or disappoints, the stock price can plummet.
So it's not just about picking companies with growth potential. It's about making sure we're not paying an inflated price for that growth.
Absolutely, and that's where Graham's concept of margin of safety comes in, which is a core principle of his investing philosophy.
This is where it gets really interesting. Like, break down this margin of safety concept for us.
Okay.
What exactly does it mean, and how do we apply it?
The margin of safety is all about buying assets at a price significantly lower than their intrinsic value.
Okay.
Think of it as a buffer, a built-in cushion to protect you from unforeseen events or even miscalculations in your analysis.
So it's like getting a discount on a valuable asset.
Yes.
Knowing that even if things don't go exactly as planned, you're still protected.
Exactly. It's about minimizing risk by buying at a price that offers a margin for error.
I like.
Now determining that intrinsic value,
Right.
that's where the art and science of investing come in.
Yeah.
And Graham dedicates a significant portion of the book to this process.
And he emphasizes that this is a long game, right?
Yeah.
Not about chasing those quick flips or trying to time the market perfectly.
Absolutely. He lays out 2 primary paths for the intelligent investor,
Okay.
the defensive investor and the enterprising investor.
Okay, tell us about these 2 approaches.
All right.
What are the key differences?
The defensive investor, also known as the passive investor, prioritizes minimizing risk and achieving consistent, steady returns.
Okay.
They're looking for a portfolio that can withstand market fluctuations and deliver reasonable returns over the long term.
So it's about building a financial fortress,
Yes,
a portfolio that can weather any storm.
exactly. Graham recommends a balanced approach for the defensive investor, typically a 50-50 split between stocks and bonds, though this can be adjusted based on individual circumstances and risk tolerance.
And the enterprising investor,
Yeah.
they're willing to put in a bit more work.
Yes. The enterprising investor is willing to roll up their sleeves, delve deeper into research, and potentially take on a bit more risk for the opportunity to achieve higher returns.
Okay.
They're looking for undervalued stocks, special situations, or market inefficiencies that they can capitalize on.
So they're more like financial detectives,
Yeah.
searching for those hidden gems in the market. Right. But this path does require more time expertise and a higher risk tolerance.
Right, it does. And Graham stresses that even for the enterprising investor, success hinges on sticking to sound investing principles and avoiding speculative traps.
So no matter which path we choose, discipline and a focus on value are key.
Absolutely. Now, let's shift gears a bit and talk about a topic that's top of mind for many investors today:
Okay.
inflation.
Yeah.
In Chapter 2, Graham tackles this head-on, exploring its impact on our investments.
This is such a crucial topic, especially with the inflationary pressures we've seen in recent times.
It is.
How does Graham suggest we navigate this challenge as intelligent investors?
He starts by reminding us that inflation is a silent wealth killer.
Okay.
It erodes the purchasing power of our money over time.
Right.
What we could buy for $100 a decade ago now costs significantly more.
And this is a threat even if our portfolios are showing positive returns, right?
Absolutely. If our investments aren't keeping pace with inflation,
Yeah.
our real returns, our purchasing power, might be stagnant or even declining. It's like running on a treadmill, putting in effort, but not getting anywhere.
So how do we combat this?
Yeah.
I know bonds are often seen as a safe haven, but Graham actually cautions against them during inflationary periods. Why is that?
With bonds, you're essentially locking in a fixed return.
Okay.
But as prices rise due to inflation, that fixed return buys you less and less over time.
Right.
It's like getting a pay cut every year.
It's not a good feeling. So bonds aren't always the safe bet they're made out to be.
They can be, but it's crucial to be mindful of the economic environment.
Okay.
Graham suggests that in times of inflation, stocks might be a better option.
But stocks are inherently riskier, aren't they?
They can be.
Subject to those wild market swings.
Yeah, but they also have the potential to grow along with inflation.
Okay.
As companies raise prices to keep pace with rising costs, their profits can increase.
Right.
Which, in theory, should boost their stock prices.
So stocks can act as a sort of inflation hedge.
Exactly. Of
Yeah.
course, there are no guarantees, and stocks aren't a perfect hedge. We've seen periods like the stagflation of the 1970s, where high inflation was coupled with a stagnant stock market.
Ooh, that sounds like a tough situation for investors. Are there any other strategies Graham recommends for battling inflation?
He suggests considering tangible assets,
Okay.
things like real estate commodities and sometimes gold or precious metals.
So
These assets tend to hold their value better during inflationary periods.
instead of paper assets, think real assets that have intrinsic worth.
Right. If the cost of building materials skyrockets due to inflation, the value of existing real estate often rises as well.
Makes sense.
It's a way to potentially preserve your purchasing power.
Does Graham advocate trying to time the market based on inflation forecasts?
He's actually quite cautious about that.
Yeah.
He believes it's incredibly difficult to predict future inflation accurately,
Yeah.
and trying to time the market based on those predictions can do more harm than good.
So stick to your long-term plan and don't get spooked by every inflation report.
That's the Graham way. He advocates building a diversified portfolio that considers inflation as a long-term factor,
Okay.
but without making rash decisions based on short-term economic news.
Now, in Chapter 3, Graham takes us on a fascinating journey through a century of stock market history. What are the key takeaways from this historical perspective?
He analyzes market data spanning from the 1870s to the early 1970s, identifying 19 distinct market cycles.
Wow.
Each cycle, with its peaks and valleys, demonstrates that market fluctuations are not anomalies. They're an inherent part of the system.
So those heart-stopping drops and exhilarating rallies,
Right.
they're not random events, but rather recurring patterns.
Exactly. And understanding these historical cycles helps us develop a long-term perspective.
Right.
Instead of panicking during downturns, we can view them as opportunities to buy undervalued assets,
Right.
knowing that the market tends to recover over time.
So it's about having the courage to stay the course,
Mm-hmm.
trusting that the market will eventually swing back in our favor.
Precisely. Now, Graham doesn't stop at simply observing these cycles.
Right. He delves into the relationship between stock prices, earnings, and dividends,
Yeah.
which often don't move in perfect sync.
That's interesting. You'd think that as a company's earnings grow, its stock price would rise accordingly.
You'd think so, but the reality is more complex stock prices can be influenced by a whole host of factors,
Okay.
including investor psychology, broader economic trends, and even speculation.
So those irrational exuberance and fear-driven panic that Graham talked about,
Right.
they can really distort the relationship between a company's performance and its stock price.
They can, and that's why it's so important to have a solid understanding of a company's fundamentals before making any investment decisions.
This brings us to another key metric that Graham highlights, the price-to-earnings ratio, or PE ratio. What's the significance of this ratio, and how can it help us make more informed decisions?
The PE ratio is essentially a measure of market sentiment.
Okay.
It tells you how much investors are willing to pay for every dollar of a company's earnings.
A high PE ratio might indicate that investors are very optimistic about the company's future prospects.
So a high PE ratio, that's a good thing, right? A sign that the company's on a roll.
Not necessarily. While a high PE ratio might reflect strong growth potential, it can also signal that a stock is overvalued.
Yeah.
Meaning investors are paying a premium price that might not be justified by the company's current earnings.
So a high PE ratio could be a warning sign that the stock price is outpacing the company's actual performance.
Exactly. And Graham uses historical examples like the crash of 1929 and the bear market of the early 1970s to illustrate the dangers of overvaluation.
Right.
These periods of excessive optimism were followed by painful corrections that wiped out a lot of wealth.
So it's a reminder that what goes up must come down,
Yeah.
especially when it comes to overhyped stocks.
Precisely, a disciplined, data-driven approach is crucial for navigating market cycles and avoiding those wealth-destroying crashes.
This all leads perfectly into Chapter 4, where Graham shifts gears and focuses on building a portfolio for the defensive investor. That individual who prioritizes safety and consistency over chasing high returns.
This chapter lays the foundation for a portfolio that can weather market storms and deliver steady returns over time.
Yeah.
Remember that 50-50 split between stocks and bonds we discussed earlier?
I do.
That's the starting point for the defensive investor.
It's like creating a balanced meal,
Yeah.
with stocks providing the potential for growth and bonds offering stability and income.
Perfect analogy. Now, Graham doesn't just say, go buy some stocks and bonds.
Right.
He provides specific guidelines for selecting both.
Let's dive into those guidelines. What does he recommend for choosing stocks?
For starters, he emphasizes diversification, suggesting holding between 10 and 30 different stocks to spread risk.
Okay.
And avoid putting all your eggs in one basket.
Makes sense. Don't bet the farm on any single company, no matter how promising it seems.
Exactly. He also advises sticking with large, well-established companies that have a proven track record of weathering economic storms.
All right.
Think blue-chip companies with solid reputations and strong financials.
So companies that have been around the block a few times and have proven their resilience?
Precisely. He also looks for companies with a consistent history of paying dividends.
Okay.
He sees dividends as a sign of financial health and a way to generate a steady income stream from your investments.
And a nice bonus on top of any potential stock price appreciation.
Absolutely. And lastly, he cautions against getting caught up in high PE ratios.
Right.
Remember, those can signal overvaluation even for seemingly solid companies.
So even for the defensive investor, valuation matters.
It does.
It's not just about picking good companies.
Yeah.
It's about making sure we're paying a fair price for those companies.
Exactly. Now, for bonds, Graham advocates prioritizing safety over chasing high yields.
Okay.
He recommends sticking with high-grade bonds, government bonds, or a top-rated corporate bonds that have a low risk of default.
So for the bond portion of the portfolio, it's about playing it safe.
Yes.
Prioritizing the preservation of capital.
Precisely. And Graham isn't a fan of frequent market timing, especially for the defensive investor. He recommends a more systematic approach called rebalancing.
Okay, let's unpack this rebalancing thing.
Okay.
What exactly does it involve?
Essentially, it's about periodically adjusting your portfolio to maintain your desired asset allocation.
Okay.
So if your stocks have performed well and now make up a larger percentage of your portfolio,
Yeah.
you'd sell some stocks and buy more bonds to bring it back to that 50-50 split.
It's like trimming a hedge to keep it neat and tidy.
That's a great visual. Rebalancing helps you stay disciplined and avoid making emotional decisions based on market swings.
Okay.
It takes the guesswork out of buying and selling and helps you capitalize on market fluctuations in a systematic way.
You're naturally buying low and selling high without having to predict the market's every move.
Exactly. It's about maintaining that balance and ensuring that your portfolio is aligned with your risk tolerance and long-term goals.
Now, in Chapter 5, Graham delves deeper into the world of stocks, specifically their role in a defensive portfolio. This might surprise some folks who view stocks as inherently risky.
It might. Graham actually argues that stocks, despite their perceived volatility,
Yeah.
have historically offered better protection against inflation than bonds,
Yeah.
and they've delivered higher average returns over time.
So stocks can actually be a safer bet in the long run.
That's Graham's argument. Of course, he's not saying to just buy any stock and call it a day.
Of course.
He reiterates the importance of careful selection and sticking to those 4 key rules we discussed for the defensive investor.
Okay.
Adequate diversification, focusing on large, prominent companies, selecting companies with a long and consistent dividend history, and being mindful of the PE ratio, making sure you're not overpaying for those earnings.
So those rules apply to both the stock and bond portions of the portfolio.
For the defensive investor, yes.
Okay, so it's all about building a solid foundation for a resilient portfolio.
Now, Graham does touch on growth stocks in this chapter. How does he view those?
That's what I'm curious about. Growth sounds good, but Graham always seems to advocate for a cautious approach.
He acknowledges the allure of growth stocks.
Right.
Those companies that are expanding rapidly and generating impressive earnings growth.
Right.
But he also injects a healthy dose of caution.
Why the caution?
Well,
If a company's growing fast, shouldn't that be reflected in its stock price?
it should, but the problem is that growth often comes at a premium price.
Okay.
Investors get so excited about future potential that they bid up the stock price to unsustainable levels.
So you might end up paying too much for that growth.
Yes.
And if the company stumbles, the fall can be pretty steep.
Exactly. Graham uses examples like IBM and Texas Instruments, both considered high-growth darlings.
Right.
But experiencing massive price declines when their growth slowed or disappointed investors.
So even with growth stocks, valuation matters.
Always. And Graham reminds us that dividends play a key role in total returns.
Okay.
Stocks that offer little to no dividend yield rely solely on price appreciation for their returns.
Which can be risky if the market takes a downturn.
Dividends provide that consistent income stream that can smooth out the ride during turbulent times.
So even for the defensive investor, a balanced approach is key.
Yes.
Don't completely shun growth stocks, but don't get caught up in the hype either.
That's a great summary. Now let's shift our focus to the enterprising investor with Chapter 6.
Okay, time to get a bit more adventurous with our investments.
Well, not too adventurous. This chapter actually focuses on what to avoid.
Interesting.
Graham calls it the negative approach.
So it's about steering clear of the danger zones.
Exactly. He starts by cautioning against investing in lower quality bonds and preferred stocks.
Okay.
Those might seem tempting with their high yields,
Yeah.
but they come with a much higher risk of default, especially when the economy takes a hit.
So not worth the gamble for the intelligent investor.
Definitely not. Graham is also wary of new issues in IPOs.
Those shiny new stocks that everyone's buzzing about.
Yep, they often hit the market with a lot of hype and inflated valuations.
Right, investors get caught up in the excitement and end up overpaying.
Precisely. And Graham's analysis shows that new issues tend to underperform over time.
Okay.
The initial buzz fades and reality sets in.
So better to stick with companies that have a proven track record.
That's Graham's view. He also advises against getting involved in speculative investments like special situations.
What are those?
These are investments that require a lot of specialized knowledge
Uh-uh.
or are driven by events that are hard to predict, like mergers or reorganizations.
Sounds complicated and risky.
They can be. They often demand a level of expertise and insider access that most investors simply don't have.
So it's a case of know your limits and stick to what you understand.
Exactly. Even for the enterprising investor, Graham emphasizes that it's crucial to avoid chasing speculative gains.
Right.
And focus on building a portfolio based on sound principles.
Sounds like a good reminder for all of us, regardless of our investing style.
Mm-hmm.
Now, I'm curious to hear about the positive side of the enterprising investor's strategy. What does Graham suggest?
Well, that's where Chapter 7 comes in. It's all about the positive side of the enterprising investor's approach.
So we've covered what to avoid. Now let's talk about what to embrace.
One of the core principles, which might not come as a surprise, is to buy low and sell high.
Isn't that the goal of every investor? Sounds a bit obvious, doesn't it?
It does, but Graham advocates for a more disciplined approach, one that goes beyond simply hoping to buy at the bottom and sell at the peak. He suggests looking for opportunities during market downturns to buy stocks that have been unfairly punished stocks that are trading below their intrinsic value.
So it's about capitalizing on the fear and panic that often grips the market during those downturns.
Precisely, it's about having the courage to go against the herd mentality and buy when everyone else is selling.
Easier said than done right. It takes a lot of conviction to buy when the market is tanking.
It does, and on the flip side, when the market is overly optimistic and prices are inflated, the enterprising investor might consider selling some holdings that have become overvalued.
So it's about recognizing those market extremes and having the discipline to act accordingly.
That's the idea, but Graham cautions against short-term market timing, which he sees as more speculative than strategic.
So don't try to predict the market's every move, but be ready to act when those opportunities arise.
Exactly. Now, Graham also discusses growth stocks in this chapter. Remember, he urged caution for the defensive investor.
Right, because those high growth expectations often come with a hefty price tag.
Precisely. But for the enterprising investor who's willing to take on more risk growth stocks can be a viable option provided they're purchased at a reasonable price.
So it's about finding that balance between growth potential and valuation.
Exactly. Don't overpay for that growth, no matter how enticing it seems. Now, Graham also dives into bargain issues in this chapter, which are essentially stocks trading significantly below their intrinsic value.
They're like hidden treasures waiting to be discovered.
Yeah, that's a great way to put it. These stocks might be out of favor for various reasons. Maybe the company is going through a temporary rough patch, or investors have simply overlooked its potential.
So it's the enterprising investor's job to unearth these hidden gems and capitalize on the market's mispricing.
Exactly. And if their analysis is correct and the market eventually recognizes the true value of the company, those bargain stocks can lead to substantial returns.
This all sounds very promising, but I imagine it takes a lot of research and confidence to go down this path.
It does. The enterprising investor needs to be comfortable going against the grain, trusting their own judgment, and having the patience to wait for those undervalued stocks to reveal their true worth.
Now, one of the most memorable chapters in the book is Chapter 8, where Graham introduces that brilliant analogy of Mr. Market.
This is where Graham's genius really shines through. He uses this simple yet powerful analogy to illustrate his philosophy on dealing with market fluctuations.
And it's an analogy that's stuck with investors for decades.
For good reason. Imagine you have a business partner named Mr. Market who's incredibly moody. Some days he's wildly optimistic and offers to buy your shares at ridiculously high prices.
And other days, he's downright depressed and wants to sell you his shares for pennies on the dollar.
Exactly. Mr. Market is a metaphor for the stock market and its tendency to swing between irrational exuberance and crippling pessimism.
So the key is not to get swept up in Mr. Market's emotional roller coaster.
Precisely, the intelligent investor recognizes that Mr. Market's offers are often driven by fear and greed, not by the true underlying value of the business.
So we should see these fluctuations as opportunities rather than threats.
Exactly. When Mr. Market is feeling down and offering to sell at a bargain, that's our chance to buy. And when he's overly optimistic and offering a premium, we can consider selling.
So we're using Mr. Market's mood swings to our advantage.
Precisely. We're not letting his emotions dictate our actions. We're staying focused on the fundamentals and making rational decisions based on our own analysis.
And that's where the margin of safety comes in again, right? Making sure we're buying at a price that protects us from Mr. Market's wilder swings.
Exactly. The margin of safety acts as a buffer against those unpredictable market fluctuations. It's like having a safety net in case our calculations are off or the market throws us an unexpected curveball.
This Mr. Market analogy is such a brilliant way to frame our thinking about the market. It helps us detach from those emotional swings and focus on the long-term value of our investments.
It does. It reminds us that the market is not always rational, and we shouldn't let its short-term whims dictate our long-term strategy.
Now, in Chapter 9, Graham explores a topic that's particularly relevant today, investment funds. With the rise of mutual funds, ETFs, and all sorts of other investment vehicles, it's a world that can feel overwhelming.
It can be. But Graham provides some timeless insights that can help us navigate this complex landscape. He starts by breaking down the different types of funds, balanced funds, stock funds, bond funds, and so on, helping investors understand the variety of options available.
It's like a guide to the fund supermarket, helping us decipher all those labels and ingredients.
Exactly. But Graham also injects a healthy dose of skepticism. He cautions that past fund performance is not necessarily indicative of future results.
So don't just blindly chase those hot funds that have been crushing it lately.
Right? Past performance can be a misleading indicator. He also stresses the importance of understanding the fees associated with funds. High fees can eat into your returns over time, so it's crucial to choose funds that are cost-effective.
That's a point that's often overlooked. We get so caught up in chasing returns that we forget about those sneaky fees that can chip away at our profits.
They can make a big difference over the long term. Now, given his emphasis on value and cost effectiveness, it's not surprising that Graham suggests index funds might be a good option for many investors.
Especially for those defensive investors who are looking for a more passive, hands-off approach.
Exactly. Index funds simply track a specific market index like the S&P 500, and they tend to have lower fees than actively managed funds.
So they provide broad market exposure without the added costs and potential underperformance of active management.
Exactly. They're a simple and efficient way to participate in the market's overall growth.
Now, in Chapter 10, Graham shifts gears and tackles a topic that's near and dear to many of our listeners, the role of financial advisors.
This is a topic that can be fraught with confusion and even mistrust, but Graham offers some sage advice on navigating this complex world. He starts by emphasizing that the primary role of an advisor should be to help clients avoid costly mistakes, not to pick winning stocks or time the market perfectly.
So it's more about guidance and protection than trying to outperform the market.
Exactly. He believes a good advisor should act more like a financial coach, helping clients develop a sound investment plan, stick to it through thick and thin, and avoid those emotional pitfalls that can derail even the most well-intentioned investor.
That sounds far more valuable than chasing those elusive hot stock tips.
It's about having a trusted partner who can provide objective advice, help you stay disciplined, and keep you focused on your long-term goals.
But finding that trusted advisor, that's the challenge, isn't it? There's so many out there, and it's hard to know who to trust.
It is. And Graham stresses the importance of choosing wisely. He recommends looking for advisors who have strong credentials, a proven track record, and perhaps most importantly, a commitment to acting in the best interests of their clients.
So integrity should be at the top of the list.
Absolutely. He warns against advisors who promise unrealistic returns or push high-commission products that might not align with your goals. It's about finding someone who will act as your fiduciary, putting your interests ahead of their own.
It's about finding that true financial advocate, someone who will guide you through the complexities of the market and help you make sound decisions.
Exactly. Now, in Chapter 11, Graham introduces the concept of security analysis for the lay investor. This is where we start to delve a bit deeper into the analytical side of investing.
This is where it gets a bit more technical, right? Trying to determine the intrinsic value of a stock.
It does, but Graham does a fantastic job of breaking down the process into manageable steps, even for those who aren't financial wizards. He emphasizes that the goal of security analysis is to assess whether a security, a stock, or bond is a good value at its current price.
So it's like a detective investigation using financial statements and other data to uncover clues about a company's true worth.
Exactly, and Graham lays out a systematic approach advising investors to scrutinize a company's earnings history, its growth potential, and the stability of its financial position.
So it's about looking beyond the hype and digging into the real numbers.
Precisely, and he cautions against relying too heavily on complex mathematical models or speculative projections.
So stick to the fundamentals and don't get lost in the weeds of fancy formulas.
That's the Graham way. He believes in a more grounded approach, focusing on key metrics like earnings per share and book value to get a sense of a company's worth.
It's about building that solid foundation of understanding before making any investment decisions.
Precisely. And he also provides valuable insights on how to interpret those numbers, recognizing that accounting can be an art as much as a science.
Now, in Chapter 12, he dives even deeper into the intricacies of earnings per share, warning investors about potential pitfalls.
This is where Graham really puts his accounting hat on, helping us understand how those earnings numbers can sometimes be misleading.
Because those numbers aren't always as straightforward as they seem.
Exactly. Graham points out that reported earnings per share can sometimes be distorted by various accounting practices or even deliberately manipulated by companies.
So those earnings reports might not always tell the full story.
That's right. He encourages investors to dig deeper and look beyond the headlines to understand how those earnings are calculated and adjusted.
So we need to develop a discerning eye when it comes to those earnings reports.
We do. And Graham also explains the concept of fully diluted earnings, which takes into account the potential impact of things like convertible securities and stock options.
Those are things that could dilute the earnings per share in the future.
Exactly. It's all about getting a more realistic picture of a company's true earnings potential, taking into account those factors that could impact earnings down the road.
So it's about understanding the nuances of those earnings numbers, not just taking them at face value.
Precisely. Now, in Chapter 13, Graham puts all these analytical principles into action.
This is where we see those concepts come to life, right? Where we get to see how they're applied in real-world scenarios.
Exactly. He examines 4 different companies, walking us through the process of evaluating their financial health, their growth prospects, and their valuation.
It's like a masterclass in putting those principles to work.
It is. He demonstrates how to scrutinize financial ratios, assess dividend history, and crucially analyze those price-to-earnings and price-to-book ratios.
So he's giving us the tools to do our own due diligence to make informed decisions based on our own analysis, not just relying on someone else's opinion.
Exactly. He's empowering investors to become independent thinkers, to understand the fundamentals of a business, and to make sound judgments about its value.
Now, in Chapter 14, we get to the heart of the matter for the defensive investor. Graham lays out his specific criteria for stock selection.
This chapter lays the foundation for a portfolio of solid, dependable stocks. A portfolio that's designed to deliver consistent returns without exposing the investor to undue risk.
So what are those 7 criteria? What should the defensive investor be looking for when evaluating a potential investment?
First and foremost, he emphasizes the importance of investing in companies of adequate size. He wants to avoid the volatility that often comes with smaller companies.
So think large-cap stocks with established track records and a proven ability to withstand market fluctuations.
Exactly. Next, he stresses the importance of a strong financial condition. He wants to see companies with solid balance sheets, companies that can weather economic storms without being crippled by debt.
So low debt and plenty of cash on hand, those are good signs.
They are. Then he looks for companies with a consistent record of earnings. He wants to see stability and profitability over time, not just a flash in the pan.
No fly-by-night operations here. We're looking for companies that have demonstrated their ability to generate profits consistently.
Exactly. Next up is dividend history. He favors companies that have a long and consistent track record of paying dividends and ideally a history of increasing those dividends over time.
Those dividends are a sign of financial strength and a commitment to rewarding shareholders.
They are, and remember, those dividends can provide a nice stream of income for the defensive investor, adding to their overall returns.
It's like getting paid to own a piece of the company.
Precisely. Now, Graham also looks for some earnings growth, but he's not looking for those super high growth rates that often come with inflated valuations. He wants to see steady, sustainable growth that's supported by the company's fundamentals.
So slow and steady wins the race, at least in Graham's view.
It often does. Next, he emphasizes the importance of a moderate price-to-earnings ratio. He doesn't want to overpay for those earnings, no matter how impressive the company's growth might be.
Always mindful of valuation, making sure that we're not getting swept up in the hype and paying an inflated price.
Always. And finally, he advises looking for a moderate price-to-assets ratio. Again, it's about making sure you're not paying too much for the company's underlying assets.
So it's a holistic approach, looking at both earnings and assets to determine whether the price is justified.
Exactly. Those 7 criteria provide a framework for building a portfolio of solid, dependable stocks. They're all about finding companies that are financially sound, well-managed, and most importantly, reasonably priced.
Now, in Chapter 15, Graham turns his attention to the enterprising investor, offering guidance on stock selection for those who are willing to put in more work and potentially reap greater rewards.
This is where Graham encourages investors to become more active, to delve deeper into research, and to seek out those undervalued gems that the market has overlooked.
It's about becoming more than just a passive investor, right? It's about taking ownership of your investment decisions and seeking out those opportunities that others might miss.
Exactly. And Graham provides a framework for this more active approach, starting with an emphasis on finding stocks with low price-to-earnings ratios. This can indicate that a company is undervalued relative to its earnings power.
So it's about finding those diamonds in the rough, those companies that the market hasn't fully recognized yet.
Precisely. He also advises looking for stocks with low price-to-book ratios. This means the stock is trading at a discount to the company's net worth, essentially giving you a bargain on the company's assets.
So you're essentially getting more bang for your buck, buying those assets at a price below their true value.
Exactly. Now, while Graham still emphasizes the importance of earning stability, he's a bit more flexible for the enterprising investor.
So maybe a shorter track record of earnings is acceptable as long as the company's prospects look promising and there's a clear path to future profitability.
Exactly. He's willing to take on a bit more risk in exchange for the potential for higher returns. He also suggests that the enterprising investor might consider investing in cyclical stocks, companies whose fortunes are tied to the ups and downs of the economic cycle, like those in the automotive or manufacturing industries.
So it's a contrarian approach, buying those stocks when they're out of favor and the industry's in a downturn, with the expectation that they'll rebound when the cycle turns.
Exactly. It takes a lot of conviction to buy when everyone else is selling, but if you get it right, the rewards can be substantial.
It's all about recognizing those cycles and having the patience to wait for the turnaround.
It is, and Graham also suggests that the enterprising investor might consider investing in secondary companies, those smaller, lesser-known companies that often fly under the radar.
Those are the companies that aren't household names, but they might have significant growth potential that the market hasn't yet recognized.
Exactly. They might not have the brand recognition or the long track record of the larger companies, but they can offer the opportunity for outsized returns.
Of course, with higher potential rewards often come higher risks.
That's always the trade-off. The enterprising investor needs to be comfortable with that risk-reward equation.
Now, in Chapter 16, Graham delves into the world of convertible issues and warrants, which for many investors can feel like a whole different language.
They can be complex instruments, but Graham breaks them down in a way that's easy to understand. He starts with convertible bonds, essentially bonds that can be converted into shares of stock.
So you get the fixed income of a bond with the potential upside of a stock. Sounds like a win-win.
It can be, but Graham cautions that convertibles often come with lower interest rates than traditional bonds to compensate for that conversion privilege.
So there's a trade-off. You're giving up some current income for the potential for future gains.
Exactly. And he also warns that convertibles can be risky during bear markets as the value of that conversion option declines along with the stock price.
So they're not a foolproof investment. You need to understand the risks involved before jumping in.
Exactly. He also discusses warrants, which give the holder the right to buy shares of stock at a specific price in the future.
So they're like a bet on the future price of the stock.
They are, but Graham is generally skeptical of warrants, arguing that they can dilute shareholder value and inflate a company's market capitalization without adding any real assets.
They're not always in the best interests of long-term shareholders.
That's Graham's view. He sees them as more speculative instruments that can create distortions in the market.
Now, in Chapter 17, Graham takes a step back from those complex instruments and returns to the core principles of security analysis, using real-world examples to illustrate those principles in action.
This chapter is a masterclass in applying those analytical tools that he's been teaching us throughout the book. He examines 4 case studies demonstrating how to assess a company's financial health, its growth prospects, and its valuation.
It's like a detective story uncovering the hidden risks and opportunities that might not be immediately apparent.
Exactly. He shows us how to dig deeper, to look beyond the headlines, and to ask the tough questions that can reveal a company's true nature.
It's a reminder that investing is about more than just looking at a few numbers. It's about understanding the story behind those numbers, the underlying business and the people running it.
Precisely. One of the cases highlights the dangers of overpaying for growth stocks, even those with impressive track records. It's a reminder that even the most promising companies can become overvalued, and buying at an inflated price can lead to disappointing returns.
So growth isn't always good if you're paying too much for it.
Exactly. Another case emphasizes the importance of financial stability, showing how companies with high debt levels can be vulnerable during economic downturns. A strong balance sheet with low debt and ample cash reserves can be a lifesaver during those tough times.
It's like having a financial cushion to absorb those unexpected shocks.
Exactly. And yet another case focuses on the importance of assessing management quality.
Because even a great business can be ruined by poor leadership.
Precisely. Graham reminds us that investing is about more than just numbers. It's about understanding the people running the business, their track record, their integrity, and their ability to make sound decisions.
It's about investing in people as much as in companies.
Exactly. Now in Chapter 18, Graham takes us through a fascinating comparison of 8 pairs of companies.
This is where we see those analytical skills put to the test, right? Comparing and contrasting companies to see what sets them apart.
Exactly. He pairs companies that have similar business activities but very different financial strategies, performance records, and valuations.
So it's like a head-to-head matchup, seeing what works and what doesn't in the real world of business.
Exactly. One key takeaway is the risk of overexpansion. Graham shows how companies that grow too aggressively or take on too much debt can stumble when the economy turns south.
So slow and steady wins the race, especially when it comes to managing growth and debt.
It often does. He also highlights the benefits of conservative management, showing how companies that prioritize financial prudence and long-term stability tend to fare better in the long run than those who favor more aggressive strategies.
So it's not just about growth, it's about sustainable growth, Growth that's managed wisely and
Yeah.
doesn't put the company at undue risk.
Exactly. And finally, Graham demonstrates how companies with similar operations can have vastly different valuations, highlighting the fact that the market doesn't always get it right.
So there are always opportunities for the intelligent investor to find those undervalued gems, those
Yeah.
companies that the market has mispriced.
Exactly. It's up to us to do our own research to dig deeper and to determine whether a stock is truly undervalued or overvalued.
Now, in Chapter 19, Graham shifts his focus to the relationship between shareholders and management, specifically exploring the topic of dividend policy.
This chapter delves into the sometimes conflicting interests of those who own the company, the shareholders, and those who run it, the management team. It's a topic that's often overlooked, but it's crucial for understanding how companies operate and how those operations impact shareholder value.
Because ultimately, as shareholders, we're the owners of the company, and we have a right to know how our money is being used and how those decisions are extracting our returns.
Exactly. Historically, shareholders have favored generous dividends, seeing those payouts as a tangible return on their investment team. Management, on the other hand, often prefers to reinvest those earnings back into the company, seeking to fuel growth and expansion.
So it's a question of short-term rewards versus long-term growth. How do we strike that balance?
That's the challenge, and Graham suggests that shareholders should carefully monitor how management is using those retained earnings. Are they investing wisely to grow the business and generate future profits, or are they squandering those profits on ill-conceived projects or lavish perks?
This was about holding management accountable, making sure they're acting in the best interests of the shareholders.
Exactly. If management can demonstrate that those reinvested earnings are generating strong returns, returns that are exceeding what shareholders could earn elsewhere, then shareholders might be content with smaller dividends.
But if management isn't using those funds effectively, then shareholders should demand a bigger share of the pie, either through higher dividends or through other means such as share buybacks.
Exactly. Graham also encourages shareholders to be more proactive in corporate governance, especially when management is underperforming or making decisions that aren't in the best interests of shareholders. He encourages shareholders to attend annual meetings to ask tough questions and to vote their shares to hold management accountable.
So it's about being an engaged owner, not just a passive recipient of dividends.
Precisely. It's about recognizing that as shareholders, we have a voice in how the company is run, and we should use that voice to ensure that our interests are being represented.
Now, in Chapter 20, Graham brings it all together, returning to that central concept that's been woven throughout the book, the margin of safety.
This is where he reminds us that the margin of safety is not just a theoretical concept, it's the cornerstone of intelligent investing.
It's that guiding principle that can help us navigate the complexities of the market and protect ourselves from those inevitable mistakes and unforeseen events.
Exactly. He reiterates that the margin of safety is the difference between the price we pay for an asset and its intrinsic value. It's that buffer that protects us from those inevitable market fluctuations, those times when Mr. Market is feeling overly pessimistic or irrationally exuberant.
So it's about buying at a price that offers a margin for error, knowing that our calculations might not always be perfect, and that the market can behave in unpredictable ways.
Exactly, and he emphasizes that the margin of safety is crucial for both bonds and stocks, although it's a bit more complex to calculate for stocks given the inherent uncertainties involved in valuing a business.
Because determining the intrinsic value of a company is more art than science, requiring judgment analysis and a healthy dose of skepticism.
It does, but Graham has provided us with the tools and principles to make those assessments, to dig deep into a company's financials, to understand its industry, to assess its management team, and to arrive at a reasonable estimate of its intrinsic value.
And he reminds us that diversification is a key complement to the margin of safety.
Absolutely. By spreading our investments across a range of assets, stocks, bonds, real estate, and perhaps even some commodities, we further reduce our risk and create a portfolio that's resilient to those inevitable market ups and downs.
So it's a two-pronged approach. Margin of safety plus diversification equals a robust and resilient portfolio.
Exactly. And with those principles in hand, we can face the market with confidence, knowing that we're not just gambling, we're investing intelligently.
Well, we've covered an incredible amount of ground in our deep dive into the intelligent investor. And I have to say, this book is a true gem. It's packed with timeless wisdom and practical advice that can benefit investors of all levels.
It is. And what's remarkable is that Graham's insights are as relevant today as they were when the book was first published back in 1949.
Absolutely. His emphasis on value, patience, discipline, and risk management are principles that will never go out of style.
They won't. And in today's market, where information overload and short-term thinking can easily lead investors astray, Graham's message of rational investing is more important than ever.
He reminds us that investing is not a get-rich-quick scheme. It's a long-term journey that requires patience, discipline, and a commitment to sound principles.
And it's a journey that can be both rewarding and intellectually stimulating as we learn about businesses, industries, and the forces that drive the global economy.
Absolutely. So whether you're a seasoned investor or just starting out, I highly recommend picking up a copy of The Intelligent Investor and giving it a read or a reread.
You won't regret it. It's a book that can truly change your financial life.
And on that note, we've reached the end of our deep dive. Thanks for joining us today.
It's been a pleasure.
Until next time, happy investing, everyone.